manage assets for environmental endowments globally. The Jane Goodall Park in Mountain, Uganda, a couple water parks in South and Latin America. So these are basically environmental endowments used for lifetime preservation of plants and animals. It's kind of a unique niche in that we build and construct portfolios with an environmental social stream. And we get often asked, well, what really is sustainability, or as socially responsible investment? It's a very catch-all. Oddly enough, it's been around 150 years, and it holds roughly in excess of $3 trillion in assets. It's not, it has substance, and it's characterized by ethical investment, sustainable investing, environmental social governance. It's sort of a catch-all. There's still struggling as to how to identify what does it mean. And to give you kind of a short history, as I said, it's been around 150 years. It was first kind of formed more from a religious standpoint. The Quakers, 150 years ago, they simply didn't want to profit off certain trade activities related to war or slavery. Notable. And then over time, evangelical Protestants, I'm having a challenge with that, had some great broader social concerns. And that was actually the first forming of what's known as the Pioneer Mutual Fund in 1928. Over time, it kind of marched to the peace movement where Methodist clergy were upset with what's going on with the Vietnam War and did not want their funds to be associated with war, hence the Pax World Fund. Now, what you'll find is we call that negative screening. It's simply just an avoidance. It doesn't mean you're really enhancing any of the intellectual processing. Well, what are the good practices? At that same time, a group called the Unitarian Association started first inking, well, what are best practices? What is good governance? What is good environmental practice? What is good stakeholder practices? And that started the early parts of what now we know as GRI, the Global Reporting Initiatives. And as time kind of went on, we know certainly it became integrated into what was in South Africa. And other attributes of advocacy and shareholder stake rights and so forth. And it has progressed to what is known as ESG, where you're taking and simply saying, all right, we're going to avoid certain industries. We're going to try to find what is best in class in behavior and governance, environmental activities. And so through this, we've sort of integrated a bit of metrics. I've worked a lot with Bloomberg. And this is kind of just to give a visual of what now our financial industry is using. This did not exist 6 months ago. I've been working with it for quite a while. And it's just phenomenal. So we'll say, okay, we'll take a company's voluntarily reported energy intensity. That's essentially how many barrels of oil per $1 million of sales they create. What's their total waste energy, water energy, board activity. I can now calculate whether or not on an earnings per share or an EBIT, earnings before interest and tax, whether or not their corporate behavior is creating or destroying value on an economic basis. It is a price point discovery in a business operation. This has never been done before. This is a real important game changer. This here is Intel, for example. Their sales have been growing, but they use less energy over time. In fact, substantially. Sales increased over 20%, but their energy consumption has gone significantly down. They're actually expected to generate over about $100 million in excess earnings because of their behavior. Compared it to Exxon. I'm not knocking Exxon, because I also show you BP would be very similar. And it's not that they're being adversely affected because they're an energy company. I want to really stress that, because it's a comparative. The analysis is a little more depth. But on 2013 projected earnings, they spend their energy consumption is about 5 times BP. They're destroying about 20% of their earnings relative to their peer group, to their activities. I can calculate this and get a sense of how their impairment might be. So that is what is ESG, is integrating these non-financial metrics into a manner to understand how is that affecting the governance. And more importantly, from a corporate perspective, this gives price information to management to change their behaviors. How are you integrating externality? So from the board standpoint here, rather the panel standpoint as to why the companies are motivated, firms that have greater corporate responsibility reporting actually have a higher firm value. Why? Greater disclosures, lower cost of capital. Another attribute, I was at the 2010 SRI in the Rockies gathering, and some gentlemen in the bond space, which that's my expertise, were identifying that on average firms that have a better environmental practices actually have a lower cost of debt, as much as 64 basis points. So there's some real economic value, lower external costs, higher value, and more importantly, I think TJ will find this interesting. In the U.S. markets, we don't have any real strong or particular rules regarding carbon. but yet, oddly enough, the market is implying some imputed value to it. Europe trades on it, Canada, Australia. And what are finding firms that have poor carbon projects or carbon behavior actually have an impairment of almost over $1 billion if they're a third or fourth trial. Bottom line is the market's penalizing whether they know it or not. So this is sort of what motivates these companies' behavior. So there's either financial value creation or there's some decision points. It just didn't exist 6 months ago. So this is kind of where it's going behind the scenes. But this is the idea here, the spirit is to raise awareness is what motivates companies to have this discussion. Why are they interested? So I'm going to pass along to John, and John's going to allow them to introduce themselves. This is just a dialogue, so I'm glad you're here.
Well, good morning. My name is John Gardner, and I have the privilege of being the Dean at the Bainbridge Graduate Institute. Been there about 1.5 years, and before that, with Washington State University, where I'm still an adjunct faculty member and working on bioenergy. Thanks, Patrick and Tom and to the Alliance for asking me to moderate. My role this morning is to be his facilitator, to throw hardballs and softballs, try to elicit questions from the audience and make this actually a real dialogue. And in thinking of this morning, and when we gathered on the phone with the 3 people that you're going to hear from this morning, I couldn't help but be struck about their background and where they're coming from sustainability, with relationship to what Patrick just said. I mean, in my own life, I've bounced back and forth between large bureaucracies or startups. And the appeal of the startup always was I didn't have to worry about the rules, I could invent my own rules. I could future-proof my own business. I think of sustainability as constraints. I think of environmental issues and social issues and profit as constraints. And I wanted to future-proof my startups around skating where the puck is going, and when those externalities come on the balance sheet, I want to be there and have that competitive advantage. That was what sustainability is about to me, and still is. But I was struck by listening and thinking of our panel, these are global, iconic firms that don't have the luxury of going off and doing that. They have the hard work of doing it with inside a large, iconic, global firm. And I really have an appreciation of BGI for that, because Gifford Pinchot, my boss, invented the term entrepreneurship, and that's how to be an entrepreneur in a big firm and make that kind of change happen. And that's why I was particularly excited about being here this morning and sitting with these 3 folks. So we're going to go in order from Jim to TJ and Kevin, but just as a primer, you know, the first iconic brand, obviously, in Starbucks. The second iconic brand in Microsoft. You can go anywhere in the world and those 2 firms put this region on the map. And Kevin is unique from the perspective of he consults on these very issues, not only with large iconic firms, but with very small firms as well. And we thought Kevin can handle that whole SME range and talk about it from the perspective of those firms and how they're trying to future-proof themselves and build sustainability as a real durability for the business. So just to set the stage, that's what we're going to hear in the next few minutes. So we're going to start, each of them are going to take, maybe 10 minutes and tell their story a little bit, and then we're going to open it up for dialogue. So, Jim, thanks.
First off, I'd say Kevin is iconic here in Seattle. So. three icons. So it's interesting. I just did a talk yesterday down in Portland at this conference, and if any of you are attending there, I apologize for being redundant. But the topic of my conversation, I'm trying to invoke a little cynicism, but it was called Sustainability Who Cares? And my goal with the conversation was really to try to get people to escape from our standard lexicon around sustainability, especially in the business world, to really drill down to their own companies or their own associations or whoever they happen to be working for, and really try to define why sustainability should matter within their organizations. And frankly, who cares? Because I think what we've seen is some significant and revolutionary progress around sustainability. But we've also seen, I think, a significant portion of the business community still treat sustainability as either a defensive mechanism for their brand, still treat it as a sidebar conversation, still treat it as a way to, quote, get folks off your back, or you name the cliche. And at think there's a limited number of folks out there who have really embedded sustainability into their business.